Investing is one of the most powerful tools for building long-term wealth, but it comes with risks, especially if you dive in without doing your homework. Whether you're considering stocks, real estate, a small business, crypto, or even an index fund, asking the right questions before investing is crucial. Far too many investors jump in based on hype, tips from friends, or fear of missing out, only to suffer losses they could have avoided. A disciplined, question-first approach doesn't just minimize risk, it increases your chances of making sound, confident decisions. In this video, we'll break down the top 10 questions you should ask before putting your hard-earned money into any investment. 1. Do I understand how this investment works? Before you invest a single dollar, you need to fully understand what you're investing in. This includes how the asset generates returns, how its value can change, what affects its performance, and any technical or financial terms that come with it. If you can't explain the investment to a friend in simple terms, you're not ready to put money into it. Lack of understanding is one of the biggest causes of poor investment outcomes, especially in complex areas like cryptocurrencies, options trading, or startups. Always do your research and ask questions until everything makes sense. 2. What are the risks involved? Every investment carries risk, and identifying those risks up front is essential. Are you at risk of losing all your money, or just a portion of it? Is the investment volatile? Could regulations change its profitability? Are you dealing with market risk, credit risk, or liquidity risk? Understanding the full risk profile of an investment allows you to decide whether it fits your risk tolerance and financial goals. If the risks feel vague or are hard to quantify, that's often a red flag. Don't invest just based on upside potential. Always factor in the downside too. 3. What's the expected return, and is it realistic? It's easy to be dazzled by promises of high returns, but you need to ask, is this return realistic given the level of risk I'm taking? Compare the expected return to historical averages for similar investments. If someone is offering you 20% returns annually in a world where the S&P 500 averages 7 to 10%, you should be skeptical. Legitimate investments are rarely get-rich-quick schemes. Clarify how returns are generated, through dividends, interest, appreciation, or cash flow, and understand how likely those returns are under real-world conditions. 4. How liquid is this investment? Liquidity refers to how quickly and easily you can convert your investment into cash. Stocks are usually very liquid. You can sell them in minutes. Real estate, on the other hand, can take months to sell. Some private investments might lock up your money for years. Ask yourself if you can afford to tie up your money for the required time frame. If you think you might need that money in the short term, for emergencies, a home purchase, or education, it might not be the right time for a low liquidity investment. 5. What fees or hidden costs are involved? Even seemingly small fees can eat away at your returns over time. Ask about management fees, commissions, transaction costs, account fees, advisory fees, taxes, and penalties for early withdrawal. For example, a mutual fund charging a 2% management fee might sound low, but over 30 years, that can cost you tens of thousands of dollars. Always check the investment's prospectus, fine print, or disclosures. Don't be shy. Ask your advisor or the platform to explain exactly how they get paid. If the fee structure is complex or hard to understand, proceed with caution. 6. What's the track record or history behind this investment? A proven track record doesn't guarantee future performance, but it does provide insight into how an investment behaves over time. Ask to see past performance data, especially during different market cycles, bull markets, recessions, high interest rate periods, etc. If it's a new investment opportunity with no track record, understand that you're taking on significantly more risk. In that case, you'll want to be even more diligent in understanding the model, projections, and underlying assumptions. Be wary of investments with cherry-picked success stories but no consistent long-term data. 7. Who is managing or running this investment, and can I trust them? Whether you're investing in a mutual fund, real estate syndicate, startup, or even a friend's new business, you must know who's in charge. Ask about their qualifications, experience, past results, and how they handle losses or market downturns. Do they have skin in the game, or are they just making money from fees while you take on the risk? Transparency, accountability, and reputation matter. A trustworthy manager will answer your questions clearly and provide documentation when asked. If someone dodges questions or pressures you into investing, walk away. 8. Does this fit into my overall financial plan? Just because an investment looks appealing doesn't mean it belongs in your portfolio. Consider whether it aligns with your short-term and long-term financial goals, risk tolerance, and existing assets. Diversification is important. If you already own a lot of tech stocks, investing in another risky startup in that sector might expose you to unnecessary risk. Every investment should serve a purpose, whether it's income, growth, or hedging against inflation. Evaluate how this new investment complements what you already have and contributes to your overall financial picture. 9. What's the exit strategy? Before you enter any investment, know how and when you can get out. Is there a lock-in period? Are there penalties or tax consequences for exiting early? Can you sell the investment freely, or do you need to find a buyer? An unclear exit strategy can leave you stuck or forced to sell at a loss during a financial emergency. For business or real estate deals, clarify the exit options, sale, merger, buyout, and the timeline. A solid investment includes a well-thought-out plan for both entry and exit. 10. What are the tax implications? Different investments have different tax treatments. Capital gains, dividends, interest income, depreciation benefits, and tax deferrals can all affect your net return. Ask how the investment will impact your tax situation. Will it bump you into a higher tax bracket? Are there any credits, write-offs, or special forms you'll need to file? Will it be taxed as ordinary income or capital gains? Poor tax planning can turn a good investment into a financial headache. If you're unsure, consult a tax professional before committing. Investing without asking the right questions is like flying blind. It may work out once or twice, but eventually, the odds catch up with you. These 10 questions are designed to make you a more informed and strategic investor. They force you to think critically, identify risks, spot red flags, and ensure that each investment fits your broader financial goals. Remember, it's okay to walk away from an investment that doesn't check all the boxes. In fact, being selective and cautious is often what separates successful investors from those who lose money. Always do your homework, seek clarity, and never invest in anything you don't fully understand. Your future self will thank you.